In the closing days of December 2025, as holiday lights flickered across global cities and families gathered in quiet celebration, a far less visible drama was unfolding in the world's commodity exchanges, one that would quietly rewrite a chapter of financial history thought permanently closed 45 years earlier. On a seemingly ordinary trading session, the price of silver pierced through $64 CTI per ounce, a level that shattered the inflation-adjusted peak set during the infamous Hunt Brothers Corner of 1980, marking the first time in modern history that the white metal had surpassed its most legendary high in real terms. Traders watching their screens in London, New York, and Shanghai paused in disbelief, recognizing that this was not merely another rally in a volatile market, but a signal that something fundamental had shifted in the global monetary and industrial landscape. The achievement carried profound implications, for silver had long served as both a monetary asset and a critical industrial input, and its relentless climb now challenged long-held assumptions about inflation, supply chains, and the stability of the broader financial system. Imagine the contrast between the frenzied trading floors of early 1980 and the algorithmic precision of 2025. Back then, telex machines and shouted orders dominated as Nelson Bunker Hunt and his brothers amassed physical silver bars and vaults across Texas and Switzerland, driving prices from under 10 to nearly 50 in a matter of months. In 2025, the surge appeared almost silent by comparison. No single billionaire family dominated headlines. No dramatic margin calls echoed through Wall Street trading pits. Yet the price had climbed steadily and inexorably from around $22 at the start of the decade to this new all-time high. This quiet ascent masked a deeper transformation, one driven not by speculation alone, but by structural changes in global industry and persistent imbalances between supply and demand that had been building for years. What made this breakthrough particularly striking was that it occurred amid a backdrop of aggressive monetary easing by central banks worldwide, raising urgent questions about whether silver was simply outperforming as an inflation hedge or signaling something more systemic about the erosion of purchasing power in fiat currencies. The breaking of the 1980 peak carried immediate consequences for millions of investors who had held silver as a store of value through decades of relative dormancy, suddenly finding their positions profoundly in the money after years of patience. Mining companies that had struggled with low margins in the 2010s now faced a windfall, with share prices surging and new projects becoming economically viable overnight, while industrial users in electronics, solar panel manufacturing, and electric vehicle production scrambled to secure supplies at ever higher costs. Governments and central banks, many of which had divested their silver reserves decades earlier, watched warily as the metal regained its historical dual role as both industrial commodity and monetary asset. This convergence of forces created a moment of reckoning. The old narrative that silver's glory days were confined to the wild 1970s and early 1980s no longer held, and a new chapter was being written in real time. Yet beneath the surface, celebration among precious metals enthusiasts lay a more unsettling reality. The rally had not occurred in isolation, but against a backdrop of persistent above-ground deficits that had drained visible stockpiles year after year, with the Silver Institute reporting shortfalls exceeding 100 million ounces annually for much of the decade. While gold garnered most of the attention as the premier monetary metal, silver's unique position, approximately half its demand coming from industry rather than investment, meant that its price surge reflected genuine physical scarcity rather than purely speculative flows. This distinction mattered profoundly because unlike gold, which could be lent and relent through fractional reserve banking practices, silver's industrial consumption was largely irreversible. once incorporated into solar panels or medical devices, those ounces were effectively removed from the market forever. The timing of this record high in December 2025 amplified its significance, arriving just as major central banks signaled continued accommodative policies into 2026, and geopolitical tensions continued to disrupt traditional supply chains. Investors who had dismissed silver as a relic of past manias now confronted evidence that the metal's fundamentals had undergone a structural shift, driven by the explosive growth of green technologies that required ever greater quantities of the conductive metal. Solar energy alone, which had expanded dramatically under government subsidies worldwide, was projected to consume over 300 million ounces annually by mid-decade, a figure that dwarfed total global mining output and forced reliance on dwindling secondary supplies. This insatiable industrial appetite, combined with restrained new mine development due to years of underinvestment, created the perfect conditions for the kind of sustained rally that had just culminated in the breaking of the Hunt brothers' adjusted peak. What made this moment particularly compelling was how it challenged conventional wisdom about precious metals cycles. For decades, analysts had argued that silver would never again approach its 1980 heights in real terms because the world had changed. Central banks no longer held significant silver reserves. Photography demand had collapsed with digital technology, and sophisticated derivatives markets supposedly prevented the kind of corner attempts that defined the Hunt era. Yet, here was silver, defying those predictions through steady accumulation rather than dramatic speculation, suggesting that market dynamics had evolved in ways that few had anticipated. The breakthrough price of $64.65 thus represented more than a numerical milestone. It embodied a validation of those who had argued that silver's supply-demand imbalance would eventually assert itself with irresistible force. As trading screens glowed with the new record in late December 2025, a broader question emerged about what this achievement revealed regarding the state of the global economy. Was this surge merely a temporary overshoot driven by post-pandemic stimulus and easy money policies? Or did it mark the beginning of a new era in which silver reclaimed its historical role as a barometer of monetary instability? The fact that the metal had outperformed gold significantly during this rally, reaching new highs while its yellow counterpart remained below its 2020 peak in real terms, suggested that industrial fundamentals were playing an outsized role. This development carried implications far beyond commodity traders, touching on everything from the viability of renewable energy transitions to the potential limits of monetary expansion in advanced economies. Ultimately, the shattering of the 1980 peak forced a reevaluation of silver's place in the 21st century financial system. No longer could it be dismissed as the volatile sidekick to gold. Instead, it had demonstrated resilience and relevance in an age dominated by technology and decarbonization efforts. The record high of $64.65 in December 2025 would be remembered not just as a price milestone, but as the moment when the market acknowledged a profound shift, one that had been decades in the making and whose full consequences were only beginning to unfold. As we examine this extraordinary event, we must return to its origins in the late 1970s, when two Texas oil billionaires attempted to corner the world's silver supply and nearly succeeded, setting in motion a chain of events whose echoes would resonate across half a century. To truly understand the significance of silver reaching $64 to $65 per ounce in December 2025, a nominal all-time high that finally eclipsed even the wildest peaks of previous eras, we must journey back to the turbulent economic landscape of the late 1970s, when the world teetered on the brink of monetary chaos and two Texas oil tycoons decided to stake their fortunes on the white metal. Nelson Bunker Hunt and William Herbert Hunt, heirs to one of America's largest independent oil empire, was built by their father, H.L. Hunt, had grown increasingly alarmed by the relentless erosion of the U.S. dollar's purchasing power following the Nixon shock of 1971, which severed the last ties to the gold standard and unleashed a decade of soaring inflation that peaked at over 13% annually. In dusty boardrooms overlooking Dallas skyscrapers and through discreet international dealings, the brothers began accumulating silver as a tangible hedge against what they saw as the impending collapse of fiat currency. Initially buying modest quantities, but soon escalating into a strategy that would dominate global markets. By 1979, their positions had grown enormous, combining physical bullion stored in Swiss vaults with massive futures contracts on the COMEX in New York, effectively controlling an estimated one-third of the world's privately held silver supply. The Hunt's campaign unfolded against a backdrop of global instability. The Iranian Revolution had disrupted oil supplies, driving crude prices to record levels and amplifying inflationary pressures worldwide, while the Soviet invasion of Afghanistan heightened Cold War tensions and prompted investors to seek safe havens in hard assets. Silver, which had languished below 6 per ounce for years, began its ascent in early 1979 as whispers of the brothers' buying spread through commodity circles, drawing in speculators who amplified the momentum with their own purchases. From September 1979 onward, the price accelerated dramatically, climbing from around $11 to over $30 by year's end, fueled not only by the Hunt's relentless accumulation, but also by broader market participation from Middle Eastern investors flush with petrodollars and American citizens desperate to protect savings from double-digit inflation. Trading floors in New York buzzed with unprecedented volume, as brokers shouted orders amid stacks of contracts representing millions of ounces, while the brothers coordinated with Saudi partners and arranged for armored transports to move physical bars across continents. As 1980 dawned, the mania reached fever pitch on January 21st, when silver spiked to its infamous intraday high of $50 to $35 per ounce, a level that, even without inflation adjustment, would stand as the benchmark for decades until the surges of 2025. The Hunts celebrated privately, their holdings valued at billions and their influence extending to the point where regulators feared they had effectively cornered the market, limiting available supply and forcing shorts to cover at ruinous prices. Yet this triumph masked growing vulnerabilities. The brothers financed much of their positions through massive loans collateralized by the rising silver itself, creating a leveraged pyramid that depended on continued upward momentum. Commodity exchanges, alarmed by the concentration of power in few hands, began scrutinizing the situation closely while Federal Reserve Chairman Paul Volcker waged his own war against inflation through aggressive interest rate hikes that tightened credit across the economy. The turning point arrived swiftly in late January 1980, when the COMEX introduced Silver Rule 7, imposing position limits and requiring liquidation-only trading for speculative accounts, effectively capping the Hunt's ability to roll over contracts. Margin requirements were raised dramatically, squeezing leveraged players and triggering forced sales that snowballed into panic. By March, as the brothers struggled to meet escalating calls from brokers like Botch Halsey, Stuart Shields, the market unraveled with breathtaking speed, culminating on March 27th, what became known as Silver Thursday, when silver plunged over 50% in a single day to below $11 per ounce. Panicked selling overwhelmed the pits, brokerage houses teetered on insolvency, and emergency loans totaling over $1 billion were arranged with involvement from the Fed to prevent a broader financial contagion that could have rivaled the stock market crashes of old. The aftermath reshaped the precious metals landscape profoundly. The Hunts faced billions in losses, eventual bankruptcy filings, and civil penalties for market manipulation, while regulators implemented stricter oversight on commodity futures to prevent such concentrations in the future. Physical silver demand shifted as industrial users adjusted to volatility, and investment interest waned for years, with prices settling into a prolonged bear market that bottomed near $4 in the early 1990s. Yet the episode left an enduring legacy, embedding the $50 mark as a psychological ceiling that markets respected for generations, even as inflation eroded its real value. Adjusting the 1980 peak to contemporary dollars yields figures well over $150 per ounce, a threshold that 2025's rally approached but had not yet surpassed in purchasing power terms. The Hunt story became cautionary lore in financial circles, illustrating both the allure of precious metals during currency debasement and the perils of overreach in thinly traded markets. What distinguished the 1980 mania from subsequent rallies was its reliance on concentrated physical and contractual control by a handful of players, rather than the broad-based structural forces that would characterize later cycles. While speculation played a role, the underlying driver was genuine fear of monetary collapse in an era when the dollar's hegemony seemed genuinely threatened. The collapse, when it came, exposed the limits of even the wealthiest individuals against regulatory intervention and market mechanics designed to maintain liquidity. As silver prices stabilized in the low single digits through much of the 1980s and 1990s, the metal faded from headline prominence, overtaken by booming stock markets and the digital photography revolution that decimated traditional film demand, a key industrial use at the time. Nevertheless, the echoes of 1980 persisted in market memory, influencing how traders approached subsequent bull runs in 2011, when silver briefly touched $49 2021 ounce amid post-financial crisis quantitative easing, and again in the 2020s as new technologies revived industrial appetite. The 2025 breakthrough to $64.65 thus represented not merely a numerical victory over the Hunt's nominal peak, but a validation that silver's fundamentals had evolved in ways that the 1980 speculators could scarcely have imagined. As we delve deeper into the mechanics of that historic corner and its dramatic unwind, the parallels and critical differences with today's rally come into sharper focus, revealing how history's most infamous silver episode set the stage for the metal's modern resurgence. The mechanics of the Hunt brothers' attempted corner rested on a sophisticated, yet ultimately fragile strategy that leveraged both physical accumulation and futures market dominance to exert unprecedented control over silver pricing. Beginning in the mid-1970s, Nelson Bunker Hunt and his brother William Herbert systematically acquired silver bullion through discrete purchases in global markets, storing hundreds of millions of ounces in fortified vaults across Switzerland and the United States, while simultaneously building enormous long positions in futures contracts on the COMEX and Chicago Board of Trade. This dual approach allowed them to benefit from rising spot prices on their physical holdings, while using futures to amplify leverage, with contracts representing delivery of silver months or years into the future, effectively tying up available supply and forcing short sellers to pay ever higher premiums to cover positions. By late 1979, the brothers and their associates controlled futures contracts equivalent to over 200 million ounces, roughly half the annual global mine production at the time, creating a vice grip on the market that sent prices soaring as shorts scrambled for physical metal to deliver against expiring contracts. Regulatory scrutiny intensified as the concentration became apparent, with the Commodity Futures Trading Commission monitoring unusual trading patterns and the exchanges themselves growing alarmed at the potential for default if the Hunts could not take delivery on their massive positions. The brothers financed their expanding empire through billions in bank loans secured against their oil assets and the rising value of silver collateral, forming a highly leveraged structure that magnified gains during the ascent, but exposed them to catastrophic risk on any reversal. Saudi partners and other wealthy allies provided additional capital, viewing silver as a hedge against the petrodollar system's vulnerabilities amid soaring oil revenues and geopolitical instability. Yet this international dimension later drew U.S. government attention with concerns that foreign influence over a critical commodity could pose national security implications in an era of energy crises and Cold War tensions. The collapse unfolded with surgical precision once regulators intervened, beginning with the COMEX's emergency measures in January 1980 that restricted new long positions and mandated liquidation for speculative accounts exceeding certain limits. These rules disproportionately impacted the Hunts, who held the majority of open interest, triggering a cascade of margin calls as prices wavered, and brokers demanded additional collateral to cover potential losses. On March 14th, as the brothers pledged oil properties and other assets to secure emergency financing, the market sensed vulnerability, and selling pressure mounted from both forced liquidations and opportunistic shorts. Silver Thursday arrived on March 27th when a desperate attempt to meet $100 million in margin requirements failed, prompting brokers to dump positions en masse and driving the price from over $15 to under $11 in hours, a 50% intraday plunge that erased billions in paper wealth and threatened the solvency of major firms like Merrill Lynch and Bache Halsey Stewart. The broader fallout extended far beyond the Hunts' personal fortunes, as Congress held hearings on commodity speculation, leading to enhanced position limits and surveillance that reshaped futures trading for decades. The brothers faced lawsuits from regulators and private parties alleging manipulation, culminating in massive fines, bans from trading commodities, and eventual personal bankruptcies that dismantled much of their inherited empire. Physical silver flooded back into the market from liquidated vaults, depressing prices through the 1980s and contributing to a prolonged bear market that saw the metal trade below $5 per ounce by the early 1990s. Industrial demand recovered slowly as volatility deterred users, while investment interest shifted toward equities during the long economic expansion under Volcker's high interest rate regime that finally tamed inflation. Critically, the 1980 episode established silver's reputation for extreme volatility, with the nominal peak of 50.35 serving as a psychological barrier that markets hesitated to breach for over 3 decades, even as inflation eroded its real value to the equivalent of well over 150 in contemporary dollars. Subsequent rallies, such as the E-2011 surge to $49.21, amid post-financial crisis monetary easing, approached but never surpassed that nominal high until the structural forces of the 2020s took hold. The Hunt collapse demonstrated the limits of individual dominance in modern regulated markets, where exchanges and governments could intervene to preserve liquidity and prevent systemic risk. Yet it also highlighted silver's unique vulnerability to supply squeezes due to its relatively small market size and dual monetary industrial nature. In retrospect, the Hunt strategy exploited genuine underlying concerns about fiat currency debasement in the post-gold standard era, but their over-leveraged concentration invited regulator backlash that accelerated the unwind. The episode influenced how later generations of traders approached precious metals, favoring diversified investment vehicles like ETFs over concentrated physical or contractual positions. Mining companies, burned by the boom-bust cycle, became cautious about expanding capacity, contributing to decades of underinvestment that left supply growth lagging behind recovering demand in the 21st century. As silver prices languished through the 1990s and early 2000s, the metal's industrial applications evolved dramatically, with the digital revolution's collapse of photographic demand offset by emerging uses in electronics and renewables. The legacy of Silver Thursday thus extends to the very dynamics enabling the 2025 breakthrough, where no single actor dominated but persistent structural deficits created sustained upward pressure. Unlike the speculative frenzy of 1980, the modern rally drew strength from irreversible industrial consumption that removed ounces permanently from circulation, combined with broad-based investment flows unresponsive to short-term regulatory tweaks. The 64.65 high in December 2025 therefore represented a paradigm shift, surpassing the Hunt's nominal record through organic market forces rather than attempted cornering. As we examine the mechanisms driving today's silver market, these historical contrasts illuminate why the current surge feels both familiar and profoundly different. The fundamental mechanism driving silver's price to $64.65 per ounce in December 2025 lies in a persistent structural imbalance between global supply and demand, one that has produced annual market deficits for 5 consecutive years, according to data compiled by the Silver Institute and independent analysts at Metals Focus. Unlike the 1980 surge, which stemmed primarily from concentrated speculative positioning and leveraged attempts to corner physical supply, the current rally has been propelled by irreversible industrial consumption that removes significant quantities of silver from circulation permanently, creating a compounding shortfall that visible stockpiles have struggled to replenish. Global mine production has remained relatively flat over the past decade, hovering around 800 to 850 million ounces annually, while recycling efforts contribute another 200 million ounces or so, resulting in total supply that consistently falls short of burgeoning demand across multiple sectors. This dynamic has drained above-ground inventories year after year, tightening physical availability and amplifying price sensitivity to even modest investment inflows. At the heart of this imbalance is silver's indispensable role in the global transition to renewable energy and electrification, where its unparalleled electric call and thermal conductivity makes it irreplaceable in key applications, despite ongoing efforts at thrifting and substitution. The photovoltaic industry alone accounted for substantial growth in consumption during 2025, with solar panel installations worldwide requiring hundreds of millions of ounces as manufacturers incorporated silver paste into increasingly efficient cells to capture and conduct solar energy. Each modern solar module typically contains measurable amounts of the metal in its conductive grids, and as governments accelerated subsidies and deployment targets amid climate commitments, the sector's appetite grew relentlessly, often consuming over 200 million ounces annually, even as technological advancements reduced usage per watt. Electric vehicles and their supporting infrastructure represented another voracious consumer, with each battery electric model incorporating 25 to 50 grams of silver in electrical contacts, wiring, and power electronics, far more than traditional internal combustion engines. Data centers powering the artificial intelligence boom added yet another layer of demand in 2025, as hyperscale facilities required vast electrical networks and cooling systems that relied on silver's properties for efficient power distribution and high-performance components. Emerging applications in electronics, medical devices, and 5G infrastructure further undid this industrial pull, ensuring that roughly half of annual silver demand came from sources that destroyed or locked away the metal indefinitely. Central banks and institutional investors, observing these trends alongside accommodative monetary policies from major economies, began reallocating portions of reserves toward precious metals, with notable purchases reported in emerging markets, seeking diversification from dollar-denominated assets. Exchange-traded products tracking silver witnessed robust inflows throughout the year, providing a financial overlay that magnified the upward pressure from physical tightness. In parallel to these modern drivers, echoes of historical patterns emerge when examining the supply constraints that characterized earlier eras of silver scarcity, though today's shortages manifest through gradual accumulation rather than acute corners. During the late 19th and early 20th centuries, rapid industrialization in Europe and America strained global silver supplies as the metal found uses in coinage, photography, and emerging electrical technologies, leading to periodic price spikes that governments addressed through monetary reforms or increased mining output. The 1980 episode, while extreme in its velocity, also reflected underlying fears of currency debasement amid high inflation, drawing speculative capital into hard assets, much as lingering concerns about fiscal deficits and debt levels have done in the 2020s. Yet the critical distinction lies in the permanence of contemporary industrial demand. Whereas photographic use collapsed with digital technology in the early 2000s, freeing up supplies, the green energy transition shows no signs of reversal, embedding silver deeper into essential infrastructure. Physical market indicators throughout 2025 underscored this tightening, with lease rates for borrowing silver in London rising sharply and visible stockpiles in major exchanges declining markedly, signaling genuine delivery stress rather than transient positioning. COMEX inventories fluctuated but trended lower relative to open interest, while regional premiums in Asia reflected localized shortages as manufacturers bid aggressively for immediate supply. Mining output faced headwinds from permitting delays, declining ore grades at existing operations, and limited new project development during the low-price years of the 2010s, leaving the industry unable to respond swiftly to the demand surge. Byproduct production from lead, zinc, and copper mines, which accounts for the majority of silver supply, remained tied to those base metals' economics, further constraining elasticity even as prices climbed. The convergence of these factors created a self-reinforcing cycle in 2025. Higher prices encouraged some thrift and non-critical applications, but stimulated investment demand as a hedge against potential monetary erosion, while industrial users secured forward supplies regardless of cost due to silver's lack of viable substitutes in high-performance contexts. Federal Reserve policy adjustments, including rate cuts that lowered the opportunity cost of holding non-yielding assets, provided additional tailwinds, weakening the dollar and enhancing silver's appeal in international markets. Geopolitical disruptions to supply chains, including trade policies affecting critical minerals, added premia in certain regions, contributing to the global spot price momentum that culminated in the December breakthrough GE-ish. Comparing the two eras reveals how structural evolution has transformed silver's market behavior. The 1980 peak collapsed under regulatory intervention and forced liquidation of leveraged positions, replenishing supplies rapidly, whereas 2025's advance has proven more resilient, supported by broad-based consumption that regulators cannot easily curtail. Analysts tracking the Silver Institute's deficit projections noted that cumulative shortfalls approaching 1 billion ounces over the half-decade had eroded buffers, positioning the market for sustained elevation rather than sharp reversion. As the $64.65 level was breached amid year-end positioning, it became clear that silver had entered a new regime defined by technological imperative rather than speculative frenzy alone. This mechanistic shift carries profound implications for the trajectory ahead, as ongoing electrification and decarbonization commitments lock in multi-year demand growth trajectories that outpace foreseeable supply expansions. The record high thus serves not as an endpoint, but as acknowledgement of a transformed fundamental landscape, one where silver's dual monetary and industrial nature amplifies scarcity in ways unprecedented since the metal's demonetization a century ago. The accelerating rally that propelled silver to its all-time high of $64.65 per ounce in December 2025 has been underpinned by NATR-entrenched power structures within the global mining industry, where a handful of major producers dominate output and constrain the market's ability to respond swiftly to surging demand. Companies such as Fresnilus, KGHM, Glencore, and Polymetal control significant portions of primary silver production, often as a byproduct of base metal mining operations in regions like Mexico, Peru, Poland, and Russia, where regulatory hurdles, environmental standards, and geopolitical risks limit rapid expansion of capacity. These institutional players have prioritized shareholder returns and debt reduction following the low price environment of the 2010s, resulting in chronic underinvestment in new Project S, as that now manifests as stagnant global mine supply hovering around 800 to 850 million ounces annually despite record prices. This concentration of production power ensures that even substantial price incentives fail to elicit meaningful supply growth in the short term, exacerbating deficits and amplifying upward pressure on spot markets. Institutional investors and exchange-traded products have emerged as another pivotal force, accelerating the rally, with silver ETFs recording robust inflows throughout 2025 as portfolio managers sought exposure to commodities amid persistent inflation concerns and declining real yields following Federal Reserve rate adjustments. Major funds, backed by institutions like BlackRock and State Street, absorbed millions of ounces through creations of new shares, effectively removing physical metal from available pools and tightening the market further as redemptions remain subdued. Central banks in emerging economies, observing the structural shifts, initiated modest silver acquisitions to diversify reserves traditionally weighted toward gold, adding another layer of institutional demand that compounded the physical squeeze. These coordinated flows from powerful financial entities transformed silver from a niche asset into a mainstream diversification tool, driving lease rates to multi-decade highs and signaling profound delivery stress in London Vault X. Mining constraints have intensified this acceleration as declining ore grades at legacy operations and prolonged permitting timelines for greenfield projects left the industry structurally incapable of meeting the explosive growth in industrial offtake. Primary silver mines, which account for only about 25 to 30% of global output, faced escalating costs and community opposition in key jurisdictions, while byproduct silver from lead, zinc, and copper operations remained tethered to those metals investment cycles, which prioritized other commodities during previous downturns. The cumulative effect of this underinvestment spanning over a decade became acutely visible in 2025, with the S. Ilver Institute projecting yet another sizable deficit, estimated between 95 and 129 million ounces, marking the fifth consecutive year of structural shortfall that eroded above-ground stocks to critically low levels. This institutional inertia within the supply chain created a feedback loop where higher prices failed to stimulate proportional output growth, instead fueling further investment demand as scarcity narratives gained traction. Geopolitical and trade dynamics further entrenched these power imbalances as tariffs and export restrictions on critical minerals disrupted traditional flows and encouraged regional stockpiling, particularly in China, which dominates refining capacity and older manufacturing. Major producers in Latin America negotiated offtake agreements with Asian buyers at premiums, bypassing Western exchanges and contributing to localized shortages that rippled through global pricing. The COMEX experienced dramatic inventory movements, with massive deliveries claimed in early December, depleting registered stocks rapidly and highlighting the divergence between paper and physical markets. These institutional maneuvers by state-backed entities and multinational corporations amplified volatility as arbitrage opportunities emerged but required substantial capital to exploit, favoring large players over retail participants. The escalation of deficits has been compounded by the irreversible nature of much industrial consumption, where silver incorporated into solar panels, electric vehicle components, and data center infrastructure is effectively lost to the market for decades or permanently. With photovoltaic demand alone projected to consume over 200 million ounces annually and EV-related usage approaching 90 million ounces, these sectors, driven by government subsidies and corporate net zero commitments, exert unrelenting pull on available supply. Powerful technology firms investing in AI infrastructure indirectly accelerated this through surging electricity requirements, spurring additional solar deployments that further strained resources. The convergence of institutional mandates for decarbonization created an inexorable demand trajectory that outpaced even optimistic recycling growth, deepening the structural imbalance. As physical indicators flashed warning signals throughout late 2025, London premiums soaring, COMEX registered inventories plunging after record deliveries, and lease rates reflecting acute borrowing costs. The market's acceleration revealed the dominance of these underlying power structures. Mining conglomerates, conservative capital allocation, institutional investors' reallocation strategies, and industrial giants' technological imperatives formed an interlocking system that propelled prices beyond historical benchmarks. The $64.65 peak in December thus crystallized years of accumulating tensions, where constrained supply chains met unprecedented demand growth under the influence of concentrated economic power. This intensification carries broader implications for global resource allocation, as escalating silver costs begin to influence the economics of renewable energy transitions and electrification efforts worldwide. Manufacturers face mounting pressure to innovate thrifting techniques or explore substitutions. Yet, silver's superior conductivity maintains its entrenched position in high-efficiency applications. The accelerating deficits underscore a paradigm where institutional forces, rather than transient speculation, dictate market outcomes, setting the stage for sustained elevation and potential further records. The climax arrived in the final trading sessions of December 2025, when silver's relentless advance culminated in a decisive breach of 64.65 yuan per ounce, a milestone that not only established a new nominal all-time high, but symbolically eclipsed the psychological shadow cast by the Hunt Brothers era over 4 decades earlier. Screens in trading rooms from New York to Shanghai lit up with the breakthrough quote as year-end positioning flows converged with physical delivery demands, pushing the metal through resistance levels that had held firm during previous rallies. This moment crystallized years of accumulating structural tensions, where persistent deficits had eroded inventories to the point that even modest incremental buying triggered outsized price responses. The record stood as irrefutable evidence that silver had transcended its historical volatility to enter a new, fundamental regime driven by technological necessity and irreversible consumption patterns. What this achievement revealed, the big truth long obscured by cycles of boom and bust, was that silver's scarcity in the modern era stems not from speculative corners or monetary crises alone, but from its indispensable integration into the infrastructure of a decarbonizing and digitizing world. The metal that once fueled photographic film and speculative manias now powers the solar panels blanketing rooftops across continents and the electrical systems propelling electric vehicles along highways, embedding itself permanently into technologies that societies have committed to on a multi-decade horizon. This structural demand, combined with a supply side constrained by decades of underinvestment and geological realities, has created a market dynamic where deficits are not temporary aberrations, but recurring features likely to persist for years to come. The $64.65 peak thus marked the market's acknowledgement of a transformed reality, one in which silver's price trajectory reflects genuine physical limitations rather than fleeting sentiment. In surpassing the Hunt brothers' nominal record through organic forces rather than concentrated manipulation, silver demonstrated remarkable resilience and relevance in an age dominated by fiat currencies and digital finance. The 1980 episode, for all its drama, ultimately replenished supplies through forced liquidation and regulatory intervention, allowing prices to revert sharply. In contrast, the 2025 rally has built upon cumulative shortfalls that cannot be quickly reversed by selling pressure alone. Mining output remains structurally capped, recycling rates limited, and industrial offtake locked in by global policy commitments, suggesting that elevated prices may be necessary to ration demand and encourage eventual supply responses. This revelation challenges long-held assumptions that precious metals rallies are inherently speculative bubbles destined to burst with systemic consequences. The broader implications extend far beyond commodity traders and mining shareholders, touching on the viability of the global energy transition itself. As silver costs rise, solar and electrification projects face margin compression unless offset by efficiency gains or subsidies, potentially slowing deployment rates in cost-sensitive regions and complicating international climate targets. Governments and corporations committed to net zero pathways must now grapple with the resource constraints inherent in their ambitions, highlighting the often overlooked material requirements of sustainable technologies. Silver's surge serves as a barometer for these tensions, signaling that the path to a low-carbon future will demand careful management of critical minerals whose availability cannot be expanded at will. Reflecting on this historic breakthrough, one cannot escape the irony that a metal demonetized generations ago has reasserted its monetary characteristics precisely because of its industrial indispensability. Investors who accumulated silver through years of relative obscurity found validation in the record high, while SK eptics who dismissed it as a relic confronted evidence of profound market evolution. The $64.65 level achieved in December 2025 will likely be remembered as the point when silver shed the lingering stigma of past manias and emerged as a serious asset class reflective of 21st century realities. Ultimately, this record high invites a deeper contemplation of how societies allocate scarce resources amid competing imperatives of growth, sustainability, and financial stability. Silver's journey from the vaults of Texas oil billionaires to the conductive grids of solar farms illustrates the unpredictable ways in which history and technology intersect to reshape markets. As the metal trades at elevated levels into the new year, its trajectory offers no simple predictions, but a compelling reminder that fundamental shifts, once underway, often prove more enduring than anticipated. The story of silver in 2025 is far from concluded. The forces that carried it to this pinnacle continue to gather strength, suggesting that higher thresholds may lie ahead. What began as a quiet accumulation of deficits has manifested as a powerful revaluation, one that underscores the enduring allure of tangible assets in an increasingly complex world. In breaking the Hunt brothers' peak, silver has not merely set a new record, it has reaffirmed its place at the intersection of industry, finance, and human progress.